negative current ratio and I deem it to be very good? Coke, did they? Yeah, sort of. Coke also have sometimes, some period. McDonald's, they have a very strong positions and they have negative. Because what? Current asset and current ratios, it doesn't capture the power of the company over the supplier, say, in case of McDonald's. Or another company, which is Walmart. Very strong retailer, super largest in the world. Sometimes they have negative current ratio. Why? Because you think about it, they were financing using these account payables. They don't have to pay account payable, right? It's so strong. People come to them begging them to keep the money. They gotta pay the supplier later. On the other hand, these current assets, they carry receivables. People pay in cash. You go to Walmart, they pay in cash, or very, very liquid, right? So they're actually financing their growth using these so-called very, well, it's against your intuitive, right? But it's actually a good thing. If your company has a negative current ratio, need to look into it, why it has a negative current ratio or quick ratios. Right? Don't just leave it as bad. I say this because some people, when they do screening for companies, they put in these two. Very ridiculous. Don't just put current ratio larger equal to 2. That's really ridiculous. When you do screening, you don't want to miss out on companies such as McDonald's and Walmart because of this ratio. A more appropriate way to look at it would be debt equities or the repayment coverage. I think debt equities, it could be long-term debt or it could be total debt. And by debt, I don't mean liability. People often mistake. Debt is different from liability. Liabilities, it includes those are so-called obligations. Debt from bank. Right? That's solid. The bank gonna get that back. Liabilities, well, you may delay. So, debt over equities. Again, this number is not to be used by itself. It needs to be used in conjunction with the industry. You need to look whether they are under leveraged or over leveraged compared to their peers. Again, it by itself is not very useful. Debt repayment coverage. I read articles from S&P and Moody. Right? They rank these. They prioritize the ratio when they do their rating, the AAA, BBB thing. They prioritize this much more than those what they call it, stand-alone ratio like debt. Because debt is not like you have to pay the whole chunk at once. Not likely, especially for long-term debt. It has been structured that way. You're going to pay it over 10 years. So the concern is more like whether you can generate enough money to pay these off in the long term, rather than stand at that point. Right? Again, debt repayment coverage, we have to use EBIT. Some people may use EBITDA because it's the money prior to interest. Like I said, debt holder, they rank higher than equity holder. So before you can get your money, actually you have to consider paying debt. I think some company will have to break down whether they in their, if a company just make a big loan, right? Say you need to see the covenant of the loan, whether they have to maintain a certain debt repayment coverage. So if they do not meet if they do not meet the standard, they may be in trouble. They'll be technically default. Right? So if they technically default, those things will fall down. The whole debt thing will immediately be required to be paid. So So be mindful. Okay, these two, degree of operating leverage. This formula is, I guess, can be taken from CNA. Yeah. Quite similar. We will fix the slide. It should be degree of operating leverage and degree of financial leverage. And it's a sort of, they will want to measure the sensitivity of your earning per share to the sensitivity of your sales. Now, that could be break out to EPS over delta EBIT. And go to change in EBIT over change in sales. Right? So this is degree of operating leverage, and this one degree of financial leverage. Time those two together, these are the so-called degree of total leverage. I've been to a talk given at CFA Institute, and one of the speakers was, he worked for Goldman Sachs, right? Chief Financial Analyst for Goldman Sachs in Asia Pacific, and he stressed this. Right? None of the presentation by students by far ever consider this, which is an economic concept, rather. An economic concept. How sensitive is your earning per share or EBIT? It's just time. You cancel those two, you get those. Right? You need to consider sales. Actually, if possible, in a manufacturing term, you actually need to determine the P, quantity of sales or unit of sales that could make you break even or profitable. Right? Okay. We go on to profitabilities. This is the most used. I purposely put all the margin together. Basically, if anything of the revenues from margin. They want to measure $1 in sales. How much of it falling down to the bottom line? Sales is top line. Sales top line. How much of money falling down to the bottom line? So you go from gross profit margins, EBIT margin, net profit margin, and again cash flow. Very broad term. It could be OCS, free cash flow, could be EBITDA. Depends on how. Sometimes the firm will give this very broad margin in the financial statement. You need to see the definition. When they say cash flow, it doesn't mean the cash flow that you think it is. So break down. Oh, sorry, you need copy? No? Anyone? Okay. Sorry. Okay. Oh, they also have EBITDA margin, but I think you know. You add back depreciation and amortization, you get EBITDA margin. Okay, move on. Yeah, this is the matrix that I made. Sorry. I did actually make some change in. People were talking about ROA or ROIC, but because I forgot that I put here is net income, so I cannot use it. I actually have to fix the slide there. The reason is, let's say, there's whenever you talk about returns, right? Return on something. There's the numerator and the denominator. You need to distinguish. Numerator can be those on the left hand side, right? And denominator could be those two there. Most used. So in terms of equities, you cannot use EBIT and EBITDA. Makes sense, right? Because it's the money not available to only equity holders. Right? So for equities, you can only use net income after adjustment, of course. SCF, be SME. Right? Anyone have done, I don't know about the CF model? You have to break down SME and SMF. So free cash flow to equities and free cash flow to firm. It's not that different. Just take into account the interest expense, basically. Again, right? Use the same. If you use numerator, it's SME. It has to be equity. Asset. These three actually not measure the returns to. It's actually measure the return from or efficiency of asset. How much you get from those assets that you invest. Right? Again, a beta makes sense because total asset. However, be mindful that in this asset, there will be operating asset and non-operating asset. You need to consider that as well. And of course, the last one, invested capital is the best. However, also the hardest to use. Because invested capital is still debate. Everyone has different formula to calculate the invested capital. Anyone have any ideas what invested capital would be? Anyone? We did go through the slides. When I say about financing for the hot dog stand. Share capital, yes. That's equity. What else? Yeah, true. Long-term debt. Or rather, I tend to be more conservative and use total debt. Right? So invested capitals, the general formula would be your total debt plus your total equities. Now it gets more complicated, huh? Not just that. Because in equities, this one is very visible. That in equities you have components such as tangible and brand or intangible. Right? So here you got, it could be tangible book or intangible inside. So should you include intangible in an invested capital? This one I want you to critically think because there's a debate concept. There's no one answers. No. Okay. One say no. Anyone else? Dungeon? Shaking mean you don't want to answer or it's a no? No. Okay, don't include. Huh? Should not be included. Wow. So 3 say should not be included. Anyone think it should be included? And if it is, why? Right? Even for the 3 of you, because I think you need to think, maybe if I'm debating with someone, what would their reasoning be? Why they want to include intangible? Rachel? Should include.
Because it determines, as in depending on the value of the intangible assets, it can actually determine future how much future revenue will be generated.
Technically, yes. Yes. Okay, so now I tell you 2 sides. People who go with tangible and intangible. People say with tangible using Rachel, people who go with only tangible, they say that intangible is an accounting cost, which is amortization. Those are evading concepts. They're not real. You cannot measure them. And you not actually bring an intangible asset and go in there and invest. Right? So tangible. That's the reasoning. These are not real. And they will be affected by amortization. Need to be adjusted. So the intangible guys say, hey, but if the company is making acquisitions, or get complicated, because they did pay money for those intangibles, did they? They did, their strategy was to own, like paying and growth. So you need to quantify the intangible part. If a company is like making huge big acquisition or they continually making acquisition, that's their strategy. They acquire for growth. Furthermore, the intangible asset got like people who support the inclusion, they would say that the tangible asset will be affected by depreciation policy. Right? And just give you an example. Say I'm earning $20 for an invested capital of $100, right? So I just earned 20%. Next year, still earn $20. Business didn't get any better, but depreciation, it reduced the tangible asset now to down 180. If you use only tangible asset, it wear out. Then suddenly your return goes up. I don't know how much that, but probably it will go up. Of course, it will go up. So that's the reasoning. Right? The intangible say you need to do like take into account a company not growing, but because their asset base start wearing down, their return goes up. Right? So that's the argument. Generally, they would include. They would not include tangible. Generally, if they want to measure purely tangible. However, I would suggest you need to look at the depreciation policy. Did they over or under depreciate, and adjust for that, right? For your capital base to not be in this situation. Okay. Overall, it would be the truest measure of return if you're combining free cash flow as in adjustment for SCFF, right? And SCFF is equal to operating cash flow. And this one you must be mindful that say you must take into account the working capital investment, which means in my hot dog stand, it means I buy more bread, more sausage, right? And the main capex, right? Do not include growth. So the formula is like that. That's the formula. And you divide by invested capital, which is, I consider, the truest applied returns measure. However, sadly, it's not almighty. It's got a weak point. It cannot be applied for firms which is rely heavily on service of people, knowledge-based firm, financial service firm. This number won't help. The reason is they have tiny tangible asset. The returns you measure, you see, it could be 50, 80%, 100%. That's quite nonsense. It's most useful for manufacturers, products, anything that has products. DuPont. Anyone have heard DuPont before? Or learned DuPont? Right? Personally, I think it's very useful. Really. It captures a lot. This is an extended version, so that's the 5-star version. Anyone who has not known about the formula can copy down, and then I'll show you an example of how DuPont is so useful. Oh, geez, actually I don't. Because the school cannot, I cannot have my USB installed here. But anyways. Is net income over EBT, earning before tax, pre-tax, before tax divided by EBIT by sales by asset turnover, and leverage. Oh, take pictures. Anyway, actually, within this DuPont analysis, the two most important components is this and this. Right? The EBIT over sales, like I said, EBIT is the purest measure of earnings. So higher operating margin always the best? Oh, sorry.
The net income must we include capital expenditure
No.
in the company? Don't need, right, for ROE.
ROE. Okay, I go back. No. Net income is net income. It's
So if it's a negative growth,
negative number.
yeah,
So your net income is negative.
yeah, let's
Like
say,
I say, net income per se is not important. You need to see why it's negative. Is it negative because the depreciation and amortization expense?
it's in the period of GFC,
Pardon?
GFC,
GFC.
the global financial crisis.
Oh, global financial crisis. And your net income is negative.
Yeah, must we add the expenditure, the capital X and stuff to be right?
Oh, you mean your net income is negative due to the financial crisis? Is that what you asked? Then how you interpret that negative numbers? Is that how you asked?
No, my question is must we add the capex
CapEx? No.
into the net income?
No. No, you don't. You don't have to. Because net income is not cash. It's pre-capex actually. It's pre-capex. That's why when you're calculating from the cash flow statement, you always start with net income. Right? It's always at the top. Net income, and then you put on all those non-cash expense, all the adjustment for working capital, etc., etc. Then you get operating cash flow before you can use that number to minus capex. Is that okay? Cool. Okay. EBIT to sale and sale to asset. Right. These two are most important. The reason is when you compare two companies from different industry, be mindful that some industry they have like very high EBIT to sales, yet this very slow, very small. Can anybody think of an example of industry like that? High margin, but very slow asset turnover. It should be obvious. You're Singaporean. Huh? Yes, indeed, real estate. That's huge margin. It costs very little to actually develop a house. They could sell, the margin could be 30%, easily operating margin. However, how many sales and how many houses you would turn over a year, very low, right? Yeah, compared to, say, contract. What industry would contrast with real estate in terms of margin and yes. Oh, true. Retailer, they only have EBIT in 2-3%, but the turnover is huge. A lot. I think you need to be mindful of CCC, and then put in there cash conversion cycle. Day sale inventory, day sale outstanding minus day sale payable. Sorry, I didn't remember the formula correctly. I'll show you guys maybe after class, after break. CCC. You can see very clear. CCC for real estate would be very terrible. You can see we get back money hundreds of days, while this guy from retailer could get back a couple of days. The cycle is faster. And problems with those companies will be different too. So the problem facing a real estate firm would be to sell more house, and the problem of a retailer would be to push up margin. Right? You need to see the strategy of the management there, different industry, why they do it like that. Okay. Growth. The hardest component to valuations, growth, always. It's very tough to interpret growth. You got sources of growth, where the growth is coming from, how you analyze it, and how you forecast it. I actually leave the forecast part away from the slide because it's tough. It's tough. And personally, I don't want to be over-optimistic, over-forecasting growth. And okay, now just go through source of growth. You guys can copy that. This is intuitively, right? selling more goods and service. Within that, you can branch out, actually. Could be you sell to the same people. So I sell to Pangchen. The other day I also sell to him, but this time I sell 2 units to him. That also increase. Or I can not sell to him and sell to someone else. I still make sell to someone else. So need to determine if they sell to the same customers, right? Then they increase the market share within that geographic area or other product services segment. You need to consider the saturation rate. When that segment will be saturated out, and they need to push up the sale outside that circle. Raising price, obviously, instead of selling to Pangchen at $1, I sell at $2. My revenue will double. You help me more. Okay, new goods and services, technology, innovation. Companies have to constantly come up with new things to impress us, especially now that we all have our smartphone, go to supermarket and tick and say, wow, look, this one also like similar, but like similar quality, cheaper price. The company is trying very hard to satisfy us as customer. And the last one, the least reliable sources of growth, buying another companies. Why am I saying this? There has been many lessons about what we call serial acquirers, like serial killers. They do not grow by themselves. They like a pyramid or a Ponzi scheme. Basically, they take money, go buy another guy. They take that guy money, go buy another guy. Right? That's a very stupid way to call the business. In the end, basically, you hold a chunk of portfolio of business that are not related to each other, and your organic growth is lousy. Right? Okay. Growth analysis. There are a couple of ways you can analyze growth. These are the 3 I would recommend, period by period. That is what I think ACB called it horizontal analysis. Horizontal growth by period. And multi-time frame. Just jot down. I will show you guys what multi-time frame is. And sustainable growth. So after you analyze it by period or using a multi-time frame, you need to think about sustainable. Is the growth 50% per year sustainable? I don't think so. Rule of thumb, if your company is growing at 20%, don't try to forecast at 10% over 5 years. Over 5 years, let alone 10 years in your model. Never. It's way too optimistic. It needs to be sustainable, and after the sustainable growth, you need to consider like saturation rate, where it will reach the reversion mean to the industry or the GDP growth. For example, if you're selling product to whole Singapore, then your revenue will grow along the Singapore GDP. That's a long-term sustainable growth. Okay, actually I want to show you guys what a multi-time frame means. Okay, this is called that component, later we do. Okay, this is what I call multi-time frame. Can you guys see it? Right? So what I'm doing here is that you can see this is different time frame. 8 years, 7 years, 6 years, 5 years, right? It's a rolling period. You need to see the trend, like say, sorry. Right? What I was there was the net income. So you can see that this company is actually very good. They roll on 8 years also increase, 7 years also increase, 6 years also increase. And because I'm doing this because you don't want to look at single period growth. Normally the model you see 3 years, and then you project those 3 years like out 10 years, and you forget that if next year, if you happen to have a very odd year, like crisis, starting from '08, your earnings is very depressed, and suddenly next year get back to normal. However, because you picked the wrong time frame, your earnings actually like shoot up. You think up 100%. But actually, if you go on a rolling basis, you see it's not that good. So that's why I want you guys to be able to see that. Okay. Keep to the slides. Management quickly. I think after this we can have a break. Of the billionaires I know, money just bring out the basic traits in them. They were judged before they had money. Simply judged for $1 billion. Character, character, character. That's what I think JP Morgan said. All about character, people. And lucky for us, as in management, they leave out a lot of traces in our 10Ks. It's not like that in Singapore, however, because due to carrying standard. In the US, they have to review more. And if you're hardworking enough, you can send them compensations. I should go over here. You should know the background from the company or with the outside. You don't want to buy into a company that they don't promote people from inside, they promote people from outside. So that's similar to a serial acquirer case. They go out to the company, they say, hey, you're working over that company, it's very good, come work for us. But they neglect the people from inside their corporation. Competency, again, this is measured and quantified by day-to-day operation, return, capital allocation, did they make some stupid M&A, and then later they write off. Right? Positive, negative traits. Again, this is top, right? Those two can quantify, can be. They have to stay in the 10K. These, top. You need to be monitored over a long time. You need to be talk to middle management, or you talk to all the analysts, how they treat the analysts, also very good. We cannot do that, sadly, because we're not in the condition to call over the US analysts. So try your best to guess their background and judge their skills on. And of course, it can be shown over whether they're shareholder friendly or not, whether they have share buyback, whether they pay dividend, whether they take due compensation. Those are signals. Okay, I think we have a break.